gentlemen, good afternoon. Welcome in.
How's it going?
I'm sitting in an air-conditioned room that's at about 65 degrees, so for me, it's fine. Are you guys heat people or cold people?
I'm a heat person.
You are?
It depends on the situation.
Yeah. If I'm wearing a suit, it can get a little bit annoying.
Oof.
But we're sitting in a nicely air-conditioned studio. But I was in the pool all morning. I kind of, as soon as this is over, I'm going to run right back to the pool and open up a cold beer.
Yeah, I have yet to ever be with a partner who is not wearing a sweater around the house, cursing my name at every possible opportunity. It's freezing.
I like a cold house.
Yeah,
I like a cold house.
Except I'm one of these clowns in the bedroom. We'll turn on an electric blanket and just stick my nose out of the out of the blanket in the 60-degree room. So it certainly is. I'm really shocked. Actually, you guys aren't doing this from a deck somewhere. It really would be not in the least bit surprising to find out you guys were sitting at the end of a key somewhere.
Maybe next week.
We should do that.
Maybe
next
week.
week.
We should do that.
The technology does allow. We are going to be talking about something that, ironically, I emailed Matthew about a couple of weeks ago off air because I honestly didn't understand the difference. And I also didn't want to, corral us into a conversation where it became apparent that I didn't understand the difference. But from what I understand, this week we're going to be talking about the difference between banks, credit unions, and basically the other guys, shall we say, and just where everyone falls into, a spot along that line. Is that a reasonable description?
Listen, yeah. First off, we know you don't know anything about mortgages. That's why we love you.
Yes, well,
and
dude, I will not exceed your expectations, which is a beautiful thing.
And yeah, it's actually there's a lot of really interesting parts to how the mortgage market operates in Canada, how it is balanced or was more balanced, and some of the events that have taken place over the last 30, 40 years that have changed it and perhaps skewed it to be a little more in favor of the Canadian banks in the name of stability. There are a bunch of different players in the market. There's, the Canadian banks, obviously, which dominate the mortgage market as far as lending goes. Credit unions who are regulated a little bit differently and in many cases can probably stretch your mortgage approval limit a little bit more. And then there are mortgage finance companies. And if you deal with a broker, in a lot of cases, they will try to steer you to a mortgage finance company. And that is partially because of interest rate, but more because of the way their mortgages are structured. Mortgage finance companies have penalties that are calculated in a different fashion from most of the Canadian banks and are typically significantly less when you're looking to break a mortgage. They also, and we spoke about this a little bit last week, there is no rate discounting with a mortgage finance company. With a Canadian bank, you have a posted rate, and then you have the rate that the client can negotiate for themselves, the discounted rate, if you will. Whereas with mortgage finance companies, the advertised rate on the website is the rate that the customer gets, is the discounted rate. It's one interest rate that calculates the penalty, one interest rate that goes to the consumer. There's no difference. So there isn't that level of gamesmanship that you see when you're dealing with a Canadian bank. Unfortunately, in 2016, the mortgage finance companies were dealt a really serious blow by the Liberal government and at the time the Minister of Finance that impacted their ability to operate. I'll tell you a little bit. So this is like total mortgage geek stuff, but it really, really is interesting. So there's something called portfolio insurance. There was something called portfolio insurance. Portfolio insurance allowed it was created in 1987, 88, something like under Mulrooney. And the idea behind it was to introduce a way for more competition to enter the Canadian mortgage market. Up until that point, if you wanted to lend money in Canada, you probably had to be a bank because the banks had a reputation and a balance sheet that allowed them to borrow money much cheaper than anybody else. And if they lent a mortgage, they could provide the security of the mortgage in addition to the security of the bank. And as a result, their borrowing power and the cost of their capital was significantly less than anybody else could ever possibly be. So what Mulrooney and the then Minister of Finance did, they said, you know what we're going to do? We're going to introduce a program where if Canadians have more than 20% equity in their home, so typically a mortgage that wouldn't go to CMHC. And as we know, CMHC is a crown corporation. It is quite profitable, and their goal, as most of us know it, is to help Canadians afford a home. And typically it's people, and now it is only people that are buying a home that have less than 20% to put as a down payment. That's an insured mortgage. Portfolio insurance was brought in to insure mortgages where the consumer had greater than 20% equity. So think about a person who has a home that is $800,000, that has $400,000 worth of equity built up in that home. So they only have a $400,000 mortgage. They would have, previous to July of 2016, from 1987 to 2016, they would have qualified for something called portfolio insurance. Portfolio insurance allowed any lender, not just a bank, to utilize the balance sheet of the Canadian government, essentially the guarantee of the Canadian government through CMHC, to access the lowest cost capital available. What this did is it spurred innovation. It created companies that are now, billion-dollar companies in Canada, like First National, MCAP, Merrick's Financial, Street Capital. There's so many of these, they're called mortgage finance companies, that came into the marketplace. And they used innovation, they used amazing customer service, technology to capture large chunks of the Canadian mortgage market, because they could compete on an equal footing on price with the Canadian banks, because they had the ability to insure the mortgages that they were doing, not just the mortgages for people who were putting down less than 20%, but also the people that were putting down or had greater than 20% equity in their home. This created competition. This decreased mortgage rates. This was very, very healthy for the Canadian mortgage market. Then, in 2000, end of 2008, beginning of 2009, we saw a massive, massive liquidity crisis in the Canadian real estate market. We saw a lot of fear in the Canadian banks. And there's a really good judge of how fearful banks are of each other and the market. It's the interbank borrowing rate, LIBOR, or the overnight. So the banks, it's the price the banks demand in order to leave money with another bank for an evening. Mm-hmm. And what happened was this price spiked, and a lot of uncertainty came into the market. And the banks needed to shore up liquidity. They needed to increase available capital on their balance sheets. This portfolio insurance product that was developed in 1987 and was entirely built to create competition in the mortgage market outside of the Canadian banks was utilized by the Canadian banks to shore up their liquidity. So what they did was, Canadian banks have uninsured mortgages where people have greater than 20% equity in their home. And then they have insured mortgages, the ones that we conventionally know of through CMHC with less than 20% down. They took all their uninsured mortgages, not all of them, but like in some cases, Scotiabank sold or pushed in $150 billion worth of uninsured portfolio insurable mortgages into this program. And they filled it up because the program is capped. It typically, the CMHC has to ask the federal government to increase the cap. And the cap at the time was at $600 billion. It had just been increased from $450 billion. What happened with all of this new portfolio insured mortgage product flowing in to this portfolio insurance product, it came very close to its cap. Now, this was very likely the riskiest time in the Canadian mortgage market. We saw property values drop. We saw a really, really stale period of time. It didn't last long. It was about 6 to 9 months, but it was very scary for the banks. And the banks and the Bank of Canada and the government of Canada decided that the best thing for the financial system would be to open up this portfolio insurance product and tell the banks, just dump everything in here. We'll put it on our balance sheet. The Canadian taxpayer will assume the risk. We'll give you liquidity so that you can continue to lend out money. And at the time, made a lot of sense.
Mm-hmm.
The problem is in 2016, the then Minister of Finance, Bill Morneau, with what must have been a playbook from the Canadian bank, said, well, we feel as though this portfolio insurance product, which is now nearing its $600 billion cap, is unfair to the Canadian taxpayer. Now, keep in mind, the Canadian taxpayer took in all the risk in 2008 and 2009. So all these mortgages that the banks were really, really worried about, they dumped into this portfolio insurance product at a time when very likely property values were low to the point where some of those mortgages might not even qualify. They filled up the product, and then 7-8 years later, property values were almost double. The Minister of Finance came out and said, this is a bad idea. We don't want the Canadian taxpayer assuming the risk for all of these mortgages. So they got rid of portfolio insurance as a product.
We started off the show, and Marcus said a great thing. I mean, I said, I know nothing about mortgages. He said, yes, that's what we like about you, and I'll do anything for a couple of compliments. But the reality is, I think I am with the vast, vast majority of listeners. And this is something that, every hopefully every 25 years, whatever, every 5 years, you might think of, but by no means, I think, do people actually understand what is going on out there. And Marcus, I will get back to your story, but just to illustrate that point, I mean, up until honestly a few weeks ago, I was one of those clowns you talked to who honestly, legitimately believed that the bank had my best interest at heart. And it wasn't until a very, very senior executive at another bank that I was whining about my existing bank with put his arm around me and said, dude, the minute you get above the branch level, they could not care less about you. You're an interference. It's the old, it would be a great job if it wasn't for the client's attitude out there. They're responsible to their shareholders. The branches, very, very, conscientious, trying to do the best they can for you. But as soon as it's out of their hand, it's an entirely different world. And boy, did I ever find that out the hard way.
Yeah, it's a business. That's the way it's run. They've been doing it for a long time, and they're extremely successful at it. And this story that I'm telling you about the history of portfolio insurance speaks to just even how strong they are at lobbying the government.
Oh yeah.
So just to finish it off, like this portfolio insurance product, which was brought in, had a $600 billion cap, was brought in to create competition and lower interest rates for the Canadian taxpayer. 75% of Canadians own a home. Right? Like that's a taxpayer. So if we're talking about protecting the taxpayer, we stuck the taxpayer with a massive risk in 2009 by letting the bank dump all of their uninsured mortgages into this portfolio insurance product. And then in 2016, when the risk level of that portfolio insurance product had been, dropped significantly to zero risk because of how much values had appreciated, we decided to abolish the program. And what that did is it hamstrung all of these mortgage finance companies. And now the result is something that every single Canadian taxpayer sees whenever they try to get a mortgage. Because the mortgage interest rate on a person who has greater than 20% equity in their home is higher than that for a person who wants to put down less than 20%. And what it has resulted in is it basically shifted the balance of power in what was once a totally fair market squarely into the hands of the banks, because the banks control the capital that's being utilized for all of those mortgages. These mortgage finance companies have to rely on these banks. So when the increased cost of capital came in for these mortgage finance companies to lend money where they previously had this portfolio insurance product, interest rates increased. And the banks just kind of sat back. They looked to see how much more expensive it would be for their competitors to operate in this market. And then once they realized where the rates were going to settle, which is now 25 to 50 basis points higher, they just pegged their own rates there. And then immediately in the next quarter after that July 2016 announcement, something called, we talked about it a little bit 2 weeks ago, something called net interest margins, NIMs, spiked up right away.
Wow.
That spike up that we saw, that increase in profitability, was just a big present handed from the Liberal government and and the Minister of Finance at the time over to the Canadian banks. And who bore that expense? None other than the Canadian taxpayer, who we are purporting to be helping. Anyways, listen, the more you dig in to the way this market behaves, the more pissed off you're going to get. So if you're listening right now and you have a mortgage and you have a question, call in. It's our favorite thing to do. Like, we do it all week and we are not sick of it. So we come on the radio on Sundays so we can do more of it.
Phone lines are open, 416-872-1010. 416-872-1010. You can give us a call. So I have the Justin Turner wedding reception GoFundMe page going. Are you suggesting maybe I should just shut down the Bank of Canada GoFundMe page, that they're okay?
Listen, the Bank of Canada might need some help. Maybe if they continue to on their fiscal and monetary stimulus plans, maybe you should maybe put something together for Trudeau so he can get a majority.
416-872-1010. Sarah is in Toronto. Sarah, good afternoon. Welcome in.
Hi, thanks for taking my call. So my $400,000 mortgage is coming up for renewal, and I'm currently talking to my bank and a broker. For some reason, I'm still waiting for the bank to finalize the new renewal rate, but the broker was quick to give me one and suggested I go with MCAP, I think that's what it was. They're offering me 1.84, and my old rate is 3.19. And I guess I just want your advice. I don't really know who they are, but my broker seems pretty confident that I should go with them. What are your thoughts?
Yeah, okay, so the perfect example. MCAP is a mortgage finance company. Previously, with the portfolio insurance product, they did extremely well. They're still continuing to do well. You're getting a really competitive rate offered to you right now on your mortgage, which is amazing. The difference between MCAP and whoever your bank is that when you take a fixed rate with MCAP, and in the event that you break that mortgage, you will not be exposed to the same interest rate differential penalty that the banks will levy upon you. And we went through that a couple episodes ago, but those penalties on a $400,000 mortgage, like for instance, you're a 3.18. If you were looking to break a $400,000 mortgage and you had 3 years left at 3.18, you'd probably be in the $20,000 range for a penalty.
A lot.
Whereas with MCAP, if you had that 184 and you were going to break it, you'd probably be looking at just paying 3 months worth of interest on that mortgage, which 1630 probably end up being about $2,200. So you always have to consider the exit of your mortgage because, again, like we say, 70% of all mortgages get broken before their maturity date. Now, as far as the security of the lender, first of all, your mortgage is a debt to you. It's an asset to the lender. So if a lender goes bankrupt, and I can't think of any example of a mortgage finance company ever having gone bankrupt, like they are a collection of assets. They're a collection of people's mortgages, and they service those mortgages. So if like for the first time ever, a mortgage finance company went bankrupt and your mortgage was held with them, all that would happen would be your mortgage with all of the standard charge terms, all of the details of that contract would just be transferred over to another lender. So your mortgage would survive. I mean, the worst case thing that could ever happen would be maybe your mortgage would get forgotten about, but I don't think anybody's going to forget about it. So you don't have to worry. It's this horrible thought process that Canadians have where they say, like, I would prefer my mortgage to be with a big, strong bank that makes billions and billions of dollars worth of profits. Well, unfortunately, you're going to pay for that privilege. You're going to pay for it in an inflated interest rate. You're going to pay for it in a huge penalty. Another example, if let's say you were going for a variable rate right now, and you were going for a variable rate with your bank versus MCAP in this case, that variable rate with MCAP affords you an amazing opportunity that your mortgage with your bank would never afford you. Because once you take a variable rate with a mortgage finance company, you know what the fixed rate you're going to lock into is on the day that you want to lock in, because it's the same interest rate they're offering new clients to come on board. It's not some different rate where, the banks calculate the rate they're going to offer you. If you're an existing client and you have a variable interest rate, the bank is going to offer you an inflated fixed rate based on the calculation of what the penalty to break your existing variable rate mortgage is. Wow. So I'd say those are the top three things for me. Number one, if you're getting a variable rate mortgage with a mortgage finance company, there's no fooling around. You know when you're going to lock into a fixed rate, what that fixed rate's going to be. Number two, you're not going to have to deal with the penalty. The penalty is, it really is a killer in any of these situations. And finally, you're dealing with a mortgage finance company. You're dealing with a set of interest rates that are published, not something that's hidden. So yeah.
Good or bad? Quickly, Sarah, good shape, bad shape? Sounds competitive offer.
Sarah's in great shape. Take the MCAP offer. Shape. It's a great interest rate. You're going to love them. They're a great lender. We do a ton of business with them. And if you want, we're happy to look over it, but it sounds like your broker's doing an amazing job for you. And I'm not surprised that your bank isn't getting back to you because you probably told your bank you had a 184. And the worst thing a bank can do, in my opinion, to their customers is not to tell them they're declined, but not to tell them anything.
Jake in Toronto. Good afternoon, Jake. How you doing?
Hey, guys. I'm kind of hot today. How you guys doing?
Too hot.
Good. Same.
We're going to do next show from a pool. We're going to do the next show in a pool.
Nice.
Everyone's invited to Marcus's deck for the next show. We're going to do it live.
Yes, perfect.
We'll do it live. All right. Anyway, Jack, what's your question? Jake, sorry.
So, I'm thinking about taking that plunge, switching from my bank to I don't know what the right term is, but I guess the non-banks. And I do a lot of the time feel like I'm getting screwed by my bank when it comes to rates and fees and whatnot. But one thing I can say is, you log into your online banking, your information's already ready at click of a mouse. You can walk into a bank. They're already always happy to greet me. I can sit down, talk to somebody. Answers are always there. Now, I know you guys, those non-banks, can beat the banks in terms of rates, but can you sort of match that service aspect? Because that's important to me. It's important to a lot of people, I think.
Okay, this is great. So you are getting great access to data from your bank. Unfortunately, the data that you're getting from your bank, the information that you get when you go into the bank, is designed to make the bank more profitable, not to make you save money. And with Cannect, just with our brokerage, you receive a suite of tools that allow you to optimize your mortgage on a daily basis. So, this is something that's proprietary to us, but we're constantly monitoring every single borrower's mortgage. So you'll know if there's ever an instance where the interest rate that you have on your mortgage could be bettered with another product. So every time a product changes in the marketplace, it updates our entire database and it sends out notifications to the customers to say, hey, Jake, your 3% 5-year fixed rate mortgage, which is maturing in 3 years, we've calculated the penalty to be $15,150. However, we noticed by switching you to a 1.7% 5-year fixed rate mortgage, you will save $21,000 over the next 3 years. You're never going to get that from a bank because the bank wants to keep your mortgage, because if it's not profitable for you, it's more profitable for them. That's number one. Number two, the mortgage finance companies that we're talking about, they were built on customer service. They were built on technology. Before any bank ever had a portal for you to log into, First National had a product called Merlin that allowed its borrowers to log in and have a look at their mortgage, have a look at their balance, make a prepayment, ask questions. The amount of, and I'll get back to this, the amount of innovation that portfolio insurance product, that mandate under the conservative government of Mulroney in 1987, what that did for our mortgage industry was so helpful. And it went so far in creating so many innovative Canadian companies, which were definitely hamstrung by this last 2016 cut of the portfolio insurance product. But all of these companies know what the consumer wants. And you're going to find with any of these mortgage finance companies the same suite of tools, if not more. The only issue is Canada is behind in something called open banking. So there's a movement all around the world right now where banks are allowing a customer's information to be shared through various platforms to the customer. So you can have products at different banks if you were in Germany or in the United States. Or, the European Union is fantastic. They're far ahead of us in open banking. And this is actually what's been identified as a threat to our fintech business here in Canada, because the Canadian banks are stymieing any progress of open banking so that they can continue to control the Canadian consumer. But what that's doing is it's preventing a lot of these innovative Canadian fintechs from using these open banking platforms to creating amazing products that can be shared all over the world. So we're probably missing out on the next phase of innovation and fintech. We're hamstringing now not only our mortgage finance companies, but also some amazing and ingenious fintech options that we have that could be created right here in Canada, because we're favoring the lobbying powers of the Canadian banks in preventing open banking from ever seeing the light of day in Canada. So in an ideal world, and I guarantee it'll happen within the next 15 years, it'll happen in the European Union a year ago, like maybe 4 years ago it happened in the European Union. It's happening in the United States. It's happening all over the world. Canada, maybe 10, 15 years, we might get there when we're embarrassed about it. But what you're seeing everywhere else in the world is the ability to share financial information amongst various financial institutions through a third-party, non-biased platform where you can access all of your financial data. Cannect has built a portal like that we offer to our customers, but we're just a small player in this business, right? And it really needs the backing of a federal government who wants to further fintech and wants to further access and unbiased information transferring to the Canadian consumer. And right now, it's unfortunate, but the lobbying power of the Canadian banks is just far too great to allow access to open banking in Canada. So in answer to your question, it was a really long-winded answer. And if you're listening to this radio show more often now, you'll see that I have lots of long-winded answers. But in answer to your question, you're going to get better information out of a mortgage finance company or a good broker that has a platform that you can utilize. You might be able to log in and access your bank account information and your mortgage information all in one spot with your bank. But the information that you're going to be getting from them is not tailored to save you money. It's tailored to keep you there as a customer and to squeeze as much out of you as they can.
Cool. Thank you.
Motivations don't change, right, Jake? Motivations don't change. Just because they have a great commercial and they tell you that they got an amazing web portal and you can have an app on your phone, it's just another way to screw with you.
You know what? They remind me of the telecom and TV industry. It's actually funny when you started saying that the
TV industry,
the federal government backs them.
Yeah, I mean, think about it.
Exactly.
Like,
Jake, I appreciate the call, buddy. Thank you.
Thank you.
Yeah.
Sorry, Marcus, go on.
Oh, well, I mean, I don't know. I thought you were going to cut me off if I was going to talk about telecom based on the ownership structure, based on the ownership structure of the radio station.
But telecom.
What I will say is, why is it that Canada has the highest cell phone costs in the entire world?
Yeah.
Like, why is it that you can go to like Algeria and Egypt and pay less for unlimited data than you pay for it in Canada?
My cab driver, when I was in Jamaica recently, he pays $15 a month, and it's unlimited everything.
I think I pay $300. I think I pay $300 a month for my cell phone bill.
Yeah, I'm like over 100.
Yeah.
The opinions expressed in this broadcast are not necessarily. Okay, before I get killed on text, I'm being funny and silly. I'm not. Oh yeah, well, you work for Bell. You're not allowed to say that kind of stuff. I've yet to get a memo from anyone saying, "Don't talk about this." So I was just being silly. Tina is in Mississauga this afternoon. Tina, thanks for calling. Welcome in.
Oh, hi, and thank you, Justin, for your candid responses. It's just so enlightening. My question is, I have a...
excuse me, Tina, what are my responses not candid?
Oh, here we go.
I'm sorry.
I think it was Marcus.
No, that's fine. Honestly, I'm gonna get out of here early. See you
Tina,
later,
can we
everybody.
start the call again and you say, just in case this ends up in a promo, hey, Marcus and Justin?
Oh, perfect. I'm so sorry. Yes, of course.
I'm kidding. We're just pulling your leg. Go ahead. What's your question?
Just joking. We're just kidding.
Okay, hi there. So my question is, I have a $344,000 mortgage. It's with one of the big 5 banks, the red one, and the interest rate is 3.69. Maturity date is a year and a half from now. And my question is, should I be renewing or should I be doing something like a HELOC?
I'm not going to answer.
Well, listen, with your mortgage coming up for renewal so soon, so if you go to your bank, always use your bank. What they're going to do is they're going to offer you, the first thing that they're going to offer you is a blended rate, and that blended rate is going to be exactly what actually Marcus was speaking about earlier, where they kind of work in the penalty to your new rate. And the rate that they start off with to create that calculation is going to be, it's not going to be a good rate, right? So,
Right.
What's your property worth?
Over $1
Approximately.
million.
Over 1 million. Okay. So I would suggest that, we run some numbers, because with your mortgage maturing next year, there's going to be a penalty. It's not going to be astronomical, but there will definitely be a penalty. We can figure out exactly what that is.
So the savings, I just ran the numbers. The savings for you to switch to whatever the lowest fixed rate right now would be for the next 1.5 years. In the next 1.5 years, you would save $10,500. So if your penalty is $10,500 or less, it's probably going to make sense. It's going to make sense for 2 reasons. Number 1, you're going to be in a lower interest rate. You're going to be paying your mortgage down faster. Number 2, your interest rate will then become that new 5-year fixed rate, that lower rate of 1.7 for another 3.5 years. So 1.5 years from today, I think we can all anticipate that interest rates will be higher than they are right now.
Yeah.
So you'll be insulating yourself from that interest rate shock 1.5 years out, which is never to be underestimated as a benefit, especially in a climate like we have right now where there's rampant inflation. So, there are ways to work with Scotiabank. I don't want to see you pay a penalty. So I would say get on the phone with Justin or someone here at the office, and we'll figure out the exact amount of that penalty. We'll figure out how we might be able to use prepayment privileges, or there are definitely ways to reduce that penalty. And if we can get it down to 3 months worth of interest on a $340,000 payment, you're going to be sub $2,000 as a penalty. And then it's a total slam dunk move. What you're going to be offered by your bank will either be a blend or it'll be differing mortgages, right? Like they'll get you further in. So they'll say, well, we'll give you a new 5-year fixed rate at 1.7%. for another portion of the mortgage. And that way, one part of your mortgage will mature in 1.5 years, another part will mature in 5 years, and you will be totally chained to the radiator there.
Okay, and what do you think of a HELOC?
I think it's a great idea. So the idea behind a HELOC is flexibility. So if you are planning to pay off a mortgage within, I think the break even is about 7 months, then you should take a HELOC. If you aren't, you should take some combination of a variable rate mortgage and a HELOC. HELOC leaves you exposed to increases in prime, which probably we will not see for the next little bit. But a variable rate mortgage is always going to be at least 1% lower than whatever the HELOC is. So the penalty to break a variable rate mortgage is absorbed, is saved by the lower interest rate of a variable rate mortgage by the 7-month mark if you compare it to a home equity line of credit. So a home equity line of credit is typically prime or prime plus a half. Variable rate is going to be prime minus 1. So it's between 1 and 1.5% of a discount off the HELOC. So if there's an amount of money that you plan on holding as debt for a period of time longer than 7 months, that should very, very likely almost always be in a variable rate mortgage. If you want flexibility to draw and pay down, you've got a ton of equity in your home. Just add a HELOC on top at a zero balance and utilize it whenever you may or may not require it. But what I wouldn't do is crystallize, like you've already got this $340,000 worth of debt. Don't flip that into a HELOC. You're just going to increase your carrying costs on it. Your actual carrying costs. It might be cheaper for you to service the debt because you'll only be paying interest, but you're only really benefiting the bank by paying more interest on that debt. So again, it's like we should have a conversation about how much you want to pay each month, but as much of it as you can keep in a variable rate mortgage or a fixed rate mortgage. That's a point to a point and a half on $350,000. You're almost $5,000 in annual interest savings between a variable rate mortgage and a home equity line of credit.
See, that's the value of this show, guys, is that I think most of us go through life paying off this thing. We never think twice about it. It's just a monthly payment that comes out, and we don't think about all the possibilities and all the maze. And, when you said during the last show, 75% of people break a 5-year lease, I was like, no, that's a crazy big amount. But you can also see how it's absolutely in the bank's interest to play this game based on just that statistic alone.
Yeah. The whole idea of breaking your mortgage too, in most cases, we should be breaking our mortgages, right? We should be relooking. Like break them all. Break them. That's what we talk about here is when we constantly stay in touch with our clients, we know exactly when the right moment to break your mortgage is. Staying in that mortgage for 5 years usually ends up in a loss of some sort.
Maybe we should just, instead of saying we're breaking our mortgages, we should just say we're bettering our mortgages. Ooh. Maybe that nomenclature might work better going forward.
I like that.
Oof. I think we're onto something. Tina, what do you think?
Oof.
Tina's gone.
Let's better your mortgages.
Yeah. Tina's gone because she knows we're unfortunately out of time. Really enjoyed this.
Something
really
Justin and I never
Justin,
figure out.
I want to say thank you so much for joining us today. Seriously. Principal broker Justin Turner, founder CEO of Cannect, Marcus Zafiris. Guys, thank you so much as always.